Good morning and welcome to this Monday, September 13th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Currently, futures trying to get off to a pretty good start this week. I mean, we got Dow Jones Futures up more than 200 points this morning. S&P 500 up 29, Nasdaq up 93, and that is after we saw a lot of selling at the end of the day on Friday and really all last week. We haven't seen too many down weeks this year, and last week was not a very good week for the market. But we're not far away from the seasonally strong fourth quarter, where we tend to see the market go up almost every year. So we do have a little bridge we've got to cross between now and beginning of October. Don't know if you saw my article in Chart Watchers over the weekend. I'll be pulling it up in just a bit. I would encourage you very strongly to go and take a look at that if you haven't already, just discussing September weakness, things that you really should be aware of. If you're a long-term investor, and you're not interested in trading, then this information really isn't that useful. But if you're a short-term trader and, you should be looking really at your capital as being your product. I mean, if you're doing this as a business, your capital is your product. I mean, that's how you make your money, is by using your capital. And some periods are better than others. And we're coming up on a period that's not very good. But good news is, we're not quite to the middle of the month. First half of the month, September, tends to be pretty strong. So we'll see, what happens as we get toward the end of next week, or the end of this week, which, by the way, is options expiration week again. I do want to invite anybody who's new to Earnings Beats. We have a Max Payne webinar. We do it the Tuesday before the Friday options expiration. We do it every single month for our members, just alerting everyone as to the possibilities of what might happen. And I'll tell you, 2021's been pretty much right on cue in terms of, seeing market movement toward Max Payne. And not only do we talk about the major indices, but we also throw out individual trading candidates. So it's a great event. That'll be tomorrow at 4:30. So if you are new to Earnings Beats, or you're not quite sure what's going on, we do have a free trial. So let me take you over first to our homepage. So if you go over to earningsbeats.com, you'll see staring you right in front of you be a start your no-cost trial. So all you do, go in there and then join today. You can take a look at what we have to offer in there, but go through this process down here. It's pretty simple, but there's no charge for 30 days. And you'll have an opportunity to come in, check out the Max Payne, check out all of our chart lists and everything. I think it would be a great opportunity to get to know us a little bit better. But yeah, so that's coming up tomorrow. I think the next 2 weeks are going to be really interesting for stock market, because I'm not really seeing any signals that are telling me that the market is due for a pullback, but I know what the history is. And like I said, I wrote about it in Chart Watchers. I'll show you that article here in just a few minutes. But there's some things definitely to know and to keep in mind as we try to navigate the next couple of weeks. Also at our homepage, if you are new to Earnings Beats, we have a free newsletter. No credit card required. You can unsubscribe at any time. We're not going to badger you if you decide to unsubscribe. Maybe we're not for you. Maybe you don't like our style, and that's fine. But it is published 3 times a week, Mondays, Wednesdays, Fridays. This morning, I put another article in talking a little bit about the historical period coming up and how technology, the XLK, has been impacted historically. So I really try to make the Earnings Beats Digest very educational in nature. There, certainly opportunities to trade stocks that we talk about, but like this morning's article, it wasn't really about a stock. It was just about the history of the market. And so, obviously the sky's the limit as far as what we want to talk about there, but I think it's a great newsletter for somebody who's trying to maybe learn a little bit more about us and also learn a little bit more about the market. I think it's a great fit. Okay, let's see, what else do we have to get started here? Well, let's go ahead and just jump into what happened at the end of last week. So we saw a lot of selling. And, as soon as we see selling, it's like I just want to flip off the news because, here comes the next bear market. I mean, that's the first thing you're going to see. Dow Jones Industrial Average down 272 points. It was a rough week for the Dow, no doubt about it. I mean, we went down. Not only did we break below recent lows like the last 60 days, but we closed there. So this morning we're getting a bounce. Are we going to be able to get back through that 20-day EMA? I don't know. Like I said, second half September tends to be a lot worse than the first half. So we'll see what happens on a bounce, whether or not we can get through some key areas. The S&P 500 lost 35 points on Friday, less than 1%, about 0.75%. And when you take it in, when you keep perspective of where the market's been, pulling back, going through these pullbacks is really not that big a deal from a long-term perspective. Short-term, of course, it's painful. But it did fall back below the 20-day, 50 days approaching. I think you got to multiple support levels down here around 43.70 or so, multiple price points down around that level. So certainly keep that in mind if we do see a sell-off later this week or into next week. The Nasdaq's been the strongest. You can see the Nasdaq just a couple of days ago, all-time high. It's pulled back a little bit, but it's literally sitting just above its 20-day EMA. So it's the only index of the 5 right now that is still trading above its 20-day EMA, and it's looking to open up, what I say, 90, 93, 95 points, something like that. So Nasdaq still looks pretty good. Mid caps down 25 points on Friday, almost 1%, back below the 50-day. Small caps back below the 50-day. So I think this sideways consolidation continues on both mid caps and the small caps. Looking at the sectors, all 11 sectors were lower on Friday. I think materials was the best one, and it fell like 0.02%. I mean, it was just barely down, but all 11 were down. And I thought it was pretty noteworthy that the 2 that did the worst were defensive groups. Normally, when you pull back, that's when we're seeing technology, financials, communication services, consumer discretionary. Notice among the 5 groups that did the worst, there were no consumer stocks in there, no consumer discretionary, no consumer staples. So it was really kind of a mixed group. I mean, I would just chalk up technology as some profit taking. We've seen some pretty good strength there recently. Healthcare had been one of the strongest groups up until maybe about 2 weeks ago, 3 weeks ago. Put in a double top there. Now we're pulling back. Certainly looks like a 50-day moving average test coming up. Financials pulling back, got gap support just around that 37, 37.5 area, which is about where we closed on Friday. So I think we got a little bit of work still maybe to do there, the downside, but I would watch maybe 37. I would be looking for support there to hold. If it doesn't, it's probably because the overall market is showing more weakness in September. That would be my guess. And of course, financials also trade along the line or kind of with the 10-year treasury yield. So when the yield is going up or down, that tends to be the thing that drives financials either up or down on a relative basis to the S&P. So currently we have the 10-year treasury yield 1.33%, barely down about 1 basis point. It's been flat here over the past few weeks. And after we saw financials move up on a relative basis, they've been pulling back and consolidating while the 10-year treasury yield's been doing the same thing. Probably the most disappointing group continues to be industrials. I mean, we're now in the month, September, when industrials tend to do well. And I can tell you, historically, their strength usually comes in the first half of September. So here we are, September 13th. And industrials really haven't shown a whole lot just yet. Truckers have been doing a little bit better. Railroad, not so much. Airlines, not so much. Got some work to do there on the industrials, no doubt about it. So anyway, that's the 10-year treasury yield. No economic reports out today of any substance. This is going to be a pretty light week in terms of, I mean, there's going to be some economic reports. Actually, let me I'll pull that up on my other computer here. Hold on 1 second. Give you an idea of some of the things maybe we can be looking at or expecting later this week. So today, nothing. Tomorrow, we have CPI. So we got the PPI on Friday, showed inflation. was still, higher than expected. I wouldn't be surprised to see CPI show the same thing. I mean, that's kind of been the pattern here of late, more inflation than expected. But the market continues to trade as though inflation's not a problem as we go forward. And as I pointed out in our daily market report last week, and I say it all the time, I'm much more interested in the market's reaction to the news than I am to the actual news itself. I think prices tell us what to worry about and what not to worry about. I think relationships, intermarket relationships, tell us what to worry about, what not to worry about. So I don't care if CPI and PPI are running hot. I mean, we were running hot back in February and March, and many of the growth stocks got hit initially back then. Those reports have continued to be hot, and we've seen growth stocks take back off again to the upside. So the market's telling me don't worry about the news, which continues to come out pretty negative in terms of the inflation. Anyway, later this week, Wednesday, we've got Empire State Manufacturing Index. I like to follow that. Industrial production will be out on Wednesday. Definitely like to follow that. Initial jobless claims on Thursday. Retail sales coming out Thursday, so that'll be big. Friday, consumer sentiment, and earnings, almost none to be heard from this week. I mean, this may be the lightest week of the quarter. I only saw one earnings report coming out today after the bell. Only one that really, to me, has the ability to kind of move the market maybe a little bit. That's Oracle. It's a multi-billion-dollar company, many billions of dollars, and it's in the software space. So, of course, it's going to have somewhat of an impact on a very large group, the software group. But other than that, I mean, we got a couple of solar reports coming up. I think Jinko Solar, JKS, Fuel Cell, FCEL, they report, but really not a whole lot going on. So, but let's go ahead and move on. So here's the article that I wrote over the weekend. What you need to know about September weakness. And in addition to historical weakness, I wanted to point out, first of all, options expiration. I don't know if you had a chance to look at this chart, but I put in here the red dotted vertical line at Friday option expiration for each month. So you can kind of see what the S&P 500 is doing. And most of the months, you can see we either topped right around that time, maybe topped just before. We saw a little weakness going into option expiration Friday, or maybe we saw a little weakness just after option expiration Friday. But you can see it's usually option expiration week that kind of gets things kicked off in terms of some selling. So, and this is it. This is the week. So I would be looking later in this week, if we do rally, and the market historically does pretty well through about the 16th of the month, which is Thursday of this week. So if we follow that seasonal pattern and we still do okay for the first 3 or 4 days this week, I would be a little careful going into Friday, and especially next week. Next week is the second worst week of the year historically. In fact, the S&P 500 has an annualized return that's negative from the 20th through the 26th. That's 7 consecutive trading days. The S&P has a negative annualized return for each of those 7 days since 1950. It's the only 7 consecutive day period of the year that has negative annualized returns every day throughout the period since 1950. The Nasdaq takes it one step further. It goes from the 20th to the 27th, 8 consecutive days. All of those days are next week and maybe fall into the following Monday or whatever. So next week is a week we need to at least pay attention to. Now, don't trying to think of the right word. Overemphasize isn't quite the right word, but anyway, I wouldn't read too much into it. I mean, yes, we do have a tendency to pull back, but it's not like we have a tendency to crash. Don't think, okay, man, Tom's talking about next week, it's going to be horrible. I'm getting out, batting down the hatches. We're going to drop 10%. No, I'm not talking at all about that. Next week, and I haven't even looked, but I'm guessing the average sell-off is maybe 0.5 to 0.75%. But that's an average over 71 years. No other period other than a period in October is that bad for a week or, an extended period of time. So it's just, beware. If you average going down 0.5% every year, some years you're going to go up. Other years you might go down 3%, 5%. I mean, I didn't go back and look at the worst periods, but just don't take it too much to heart. Be aware of it. Personally, what I'm doing is just building a little bit more cash. I mean, if I like a stock and it's trading well, I'm not selling that stock going into next week. I might trim it a little bit. And then if it does pull back, I just buy my position back a little bit lower. But that's the way I'm going to be approaching this week. I'm going to be using any strength to start to trim some positions, just to be a little bit more cautious going into next week. I'm not going to be 100% cash unless something else shows up later this week. All of a sudden, you start getting some pretty serious sentiment issues or something like that, or negative divergences start popping up everywhere. Then I might get a little bit more defensive. But my goal is just to use this week, if it does strengthen, to maybe build a little bit of cash. And when I say a little bit of cash, I'm talking about maybe 20, 30% cash. So I'm still going to keep a lot of money at work. If I have a good week and, some stocks I own do very well, maybe I go to 50%, just take more profits. But that's, kind of what I'm looking to do. All right, let's keep moving. So let's take a look. I want to just talk a little bit about rotation. And I always talk about rotation, but when I look at it on a relative basis. I always like to look at our sectors relative to the S&P 500. So if you pull up the XLK just by itself, and let me see if I can do that for you here. All right, so here is the XLK just trending higher and higher and higher. So you look at it and you think, well, it's doing really well. So if I'm in the XLK, everything's great. Pullbacks, but higher highs and higher lows. We're trending higher. Everything's great. And for the most part, that's true. Technology has been a great area to be in. But look at it on a relative basis. When we topped on a relative basis in February, we didn't clear that again until just here over the past couple of weeks. So yes, technology has been strong and it's been going up, but since February, since this high back here, it's been going up, but it's been going up less than the S&P 500 throughout that entire period. Now, there have been times when we've been going up very, very strongly relative to the S&P, but there have been other periods where we, got hit very hard. And this is what's made trading, I think, pretty difficult in the market. I think a lot of it's been the inflation fear. I think a lot of it's been the move out of the when the yields were moving up, all of a sudden the rotation went over to financials and industrials and away from communication services. Well, not so much communication services, but consumer discretionary and technology. And then once financials and industrials began to weaken, then we've seen, this pickup again in technology. But rotation is really the big part. I mean, that's what you need to be focusing on. In a secular bull market, almost everything looks good. So let me show you energy. Now here's the absolute chart on energy. And this is a year-to-date chart, by the way. That's what I've been doing here. So we went up in January, pulled back, had a huge move, pulled back, went to new highs, pulled back. And now it just looks like we're consolidating. So, if you look at energy and you look at where we were to start the year, 37, and where we are now, almost 48, you might think, hey, energy has been a great place to be. And there have been pockets of relative strength, but look at the relative chart on energy. Let me get this one up for you. So back when energy topped on a relative basis, back at the beginning of March, look at what we've done. I mean, we went down, had a little bit of a bounce, and then went to a new low. And the thing you have to understand with energy is if we go back, I mean, this is a daily chart just year to date, but if we do a weekly chart and we go back, the last 10 years, it looks like we're continuing what we've been doing for a decade. I mean, the one possible thing that I do like, not one possible thing, the one thing I do like about this chart is that potentially we might be in a relative bottoming head and shoulder pattern. Left shoulder, neckline, head, neckline, right shoulder. And if that's true, we should definitely be moving from here back to the upside on a relative basis. So what I would be doing is looking at the individual chart on energy. If we go back down and we break below this low, I think I would be completely out. I mean, I'm out of energy anyway. I'm not an energy fan, as most of you probably know. But that would really kind of put the nail in the coffin for me if we were to break back below about 45.75 because of that long-term pattern. And if we're not holding in that reverse right shoulder, the bottoming right shoulder, then I don't want to have any part of this. And don't lose sight of this long-term downtrend. The other thing that will impact energy, no doubt, is going to be the dollar. So does the dollar strengthen? If the dollar is strengthening and energy is going down, avoid the group. All right. I'm going to just take a look pretty quickly at the healthcare group. So I thought what we would do, I like to break down these groups and just to give you a little sense of how I approach areas of the market. You know, I'm looking at the healthcare group here. It's been pretty strong. On its last attempt at a breakout beginning of September, you can see the PPO had struggled. We had been holding the 20-day, but with that negative divergence, it was time, I think, for healthcare to pull back. So I think this is going to be an opportunity in healthcare as we pull back. I don't know how far we're going to go back. Probably going to struggle through September would be my guess. And then as we move into October, we'll want to revisit. Now, so this is just the sector look. But if I pull up the relative strength of the industry groups, which we keep a list of, and we go down here to the healthcare, this would be the next thing that I would look at. So we've got healthcare providers down at a pretty important support level. If healthcare weakens and we can't hold this relative support level, then I'd be really careful with the healthcare providers. If we hold, though, and you see this start to turn back up again, that could be an opportunity. Medical equipment, even though healthcare is going down, look at what medical equipment's doing on a relative basis. It's actually outperforming the S&P while healthcare is underperforming the S&P, or at least going down with it. So I actually like the medical equipment group. So if I'm looking for healthcare stocks, this is definitely a group that I would be interested in. Pharmas, yeah, I don't really like what happened. Pharma's had a chance. They broke out, went above the 20, went above the 50, and it looked like we were going to get some relative momentum going. Keep in mind, the PPO is not the PPO of pharmas. It's the PPO of the relative performance of pharmas versus the S&P. So this is relative momentum. We got all the way back to the zero line. It looks like we're rolling over. Look at what's happening here. This is a long-term downtrend. We had a short move to the upside. Now we're turning back and rolling over. I'd be careful with pharmas. Medical supplies, however, doing very well, kind of like medical equipment. So as you go through, you can kind of see the areas that Wall Street's favoring, which versus the ones they're not. Medical supplies, medical equipment, both strong and strengthening. Pharmas, healthcare providers, both weakening. And then you have biotechs, and biotechs been strong on a relative basis since April, but not showing meteoric rise on a relative basis to the upside, or not really showing a whole lot of weakness to the downside. Actually, over the last 5 weeks, we've been relatively flat. But this is just telling us we're flat with the S&P 500, not flat overall. We're going higher. Biotechs have been doing very well. But over the course of the last 5-6 weeks, the S&P 500 has also been doing very well. So we've just been going along for the ride. I would be a little bit more neutral on biotechs. I'm going to say I'm on the bullish side of neutral. We are trading above the relative 20-day and 50-day. The 20's crossing above the 50. The relative PPO is positive, even though it's just slightly. So I'm going to give the nod to the bulls here. But I think the two better groups right now, medical supplies and medical equipment. And then what I would do, having that knowledge is, there's so many tools you can use at stock charts. And it's the reason why we feature stock charts in our service. And, it's something I use. I use stock charts in my trading. So if I'm going to have a service, why wouldn't I want to have stock charts in it? We try to teach. I try to teach the way that I use stock charts. That's part of what we do in terms of education. But if you go down here under summary pages, so right here, summary pages, down at the bottom is scooter reports. And if you don't know anything else about stock charts and you're looking at these relative strength charts that I've been showing you, one great way to use stock charts is just to go in. This is, I like looking at relative strength a number of different ways. This is a good way. It's limited. Everything in, technical analysis is limited to some degree. Just keep in mind scooter reports, which is Stock Charts Technical Rank, SCTR, Stock Charts Technical Rank. It's developed by John Murphy. It's a way of comparing stocks within certain universes. So, for instance, all the large caps are ranked based on scooter scores. We can go to mid caps and see how they're ranked. We can go to small caps. So it's based on a universe. So you're not comparing large cap stocks to small cap stocks, which makes sense because sometimes large caps are simply just doing better, which has been, mostly of late. But the cool thing here is once you have an area that you like, let's say you like small cap stocks and you like the medical area, medical supplies. Well, if you go in here and just type in this box, medical supplies, it not only brings up all the small caps that are in this space, but it's in order of scooter. So you can quickly look at this to see which small cap medical supply companies show the best relative strength. Now, the limitation on the scooter for me is that if you look at the formula, you're not going back more than about 5 to 6 months. So what you could have, and especially if you look at like energy, when energy was doing really well for about 3 to 5 months, all of the energy stocks would have been coming up to the top of the scooter board, the leaderboard for scooters. But you'd lose sight of the fact that energy has been going down versus the S&P 500 for 10 years. So the scooters are just looking at the last 5 or 6 months, and there for a period of time. For energy, if I go back and look at this chart on energy, when we had this move right here, that would have been about a 5-month period. So every energy stock would have been up the top of the, or mostly energy stocks would have been top of the leaderboard for scooters. And look what happened afterwards. We resumed that downtrend. You have to understand all the limitations of whatever it is that you're using, whether it's a technical indicator, whether it's the PPO, whether it's RSI, whether it's a price relative chart, whatever it is, you always have to understand the limitations. There's nothing, in my opinion, in the stock market that just works every time. All right. So let's go back over here. So there's your, so let's say large cap, you wanted large cap medical equipment stocks. Well, you just go in here and type in your medical equipment. And there are the top performers right now relative to their peers. Large cap peers, not just medical equipment peers. Now, if you want to see how something works relative to its peers, let's just do RMD, Watt, and DHR. RMD, Watt, DHR. I would do RRG. RMD, Watt, DHR. Now, those are just 3. You can put as many in here as you want. And I'm going to use the benchmark. Now I want to see how it's doing versus my benchmark, which in this case will be the medical equipment. And then just hit the update. And you could do a center like that so you can kind of get a sense of, put the longer tails on it so you can see where a stock has been relative to its group. You can see RMD to me is by far the best. It's made a huge, this is a powerful run because the tail is so long. Watt, meanwhile, still is way over here on the right side. So it's still relative strength. All 3 of them, strong relative strength, which is what we'd expect because we just picked the 3 top relative strength picks in this group. So of course they should be over here, but I really like the move that RMD has made. And then you simply go in and take a look at the chart. So that's the way when I break it down, when I talk about breaking down a group, I'm going to start with the sector, work my way through the industry groups, and then I'm looking for individual stocks. And then I'm going to go look at the charts. Now, being an earnings beats member, we can take it one step further because we all have all these chart lists. So we can go in and let's just, so I can go in here and I can pull up, for instance, our strong earnings chart list. Go to view all. Summary. All right, so that's all of them. And then what I can do, and by the way, we are open, so this is live, but then I can type in medical equipment. And so here are the stocks on our strong earnings chart list. And then in the columns, sectors, industry groups, and scooter. So there they are. So you can break it down, find the groups that you like based on, whatever. And then here you come over to the chart list, strong earnings chart list, and you type in medical equipment. I mean, that's the beauty. And then you hit the scooter rank and you'll see there's RMD. So now we know RMD, and there's Watt, and there's DHR. So all three of these beat revenue and earnings estimates. So you can quickly go through and find out a lot of information using break it down, using the tools at stock charts, and using our research at earnings beats. I think it's pretty fascinating. And then, of course, you could pull the chart up, just take a look, see what's going on. It's been a great performer. Just keeps going up, up, up. All right. Like I said, we're going to get ready to wrap up here, but Oracle was the only earnings report really of any significance coming out this week. And Oracle's been trending higher. I've got some mixed signals. I'm going to be a little bit more on the bullish side of neutral on Oracle going into their report. I see the AD line starting to weaken. We're at about a 2-month low. So that's a little concerning. It's been 3 months since we set a new high on a relative basis versus software. That's a little concerning, but you're in a strong group. I think overall, Oracle was making a big run here on a relative basis versus software when it had its highest volume. So it looks to me like there maybe was some accumulation going into quarter end. And now that they've ended their quarter and they're in this quiet period, we've just seen consolidation. So, it's just a gut feeling. My gut feeling is Oracle reports strongly tonight. We'll see. All right, let's wrap up with the 3 you must see. Actually, before we even get into that, I do want to show you one other thing about earnings, because over the next 2 weeks, I think if we do pull back, one of the things that I'm going to be looking at, this is one of our newer chart lists that we just put on our website recently, and it's the earnings AD chart list. And it's in order. If you look at it, these numbers, 1 all the way down to 57, it's in order of the biggest hollow candles, if you will, the day of earnings. So these are companies, it doesn't mean they beat earnings. They could have missed earnings. All right. So this is different than our strong earnings chart list. It's also different than our strong AD, accumulation distribution chart list, because that's just looking out over a period. This is taking into account 1 day earnings reaction. That's all we're looking at. If you look at this candle, massive volume, and that was another factor I used. I wanted to see big volume. And if it was just an average day of volume, then how can there be a whole lot of accumulation if there's no volume? So I've been looking for good volume, and then I'm looking for these big hollow candles. To me, that's a very important sign of possible accumulation. And so when I see that, that's going to make me start to think. Now, notice this stock's not in an uptrend. It just had massive accumulation in 1 day after its earnings report. And since then, it's pulled back, but it's starting to trend to the upside. So this is one I think looks kind of interesting. We'll see what it's doing today, if anything. Now it's actually down today. So maybe if it gets back close to that 20-day moving average, could be an opportunity. Who knows? But this is a stock that has been trending higher. And like I said, that was one stock that had very strong. Now, the next one, look at the next one. This is SI Time. This is a semiconductor. Look at that candle after earnings. And while it wasn't the biggest volume on the year, it was certainly the biggest of the last 5 months, maybe 6 months. So pretty good volume. And the next one, you got Doximity, DOCS, and you can see here earnings related 2 days in a row with very solid volume, 2 big hollow candles. That looks like accumulation. Anyway, what I'm going to be doing is following this chart list. And if we pull back, I'm going to be scouring this list consistently, looking for stocks that are getting back to key support levels. Maybe not all the way back down here. I mean, chance of Doximity going from 105 back to 60 is not very great, but chance of it maybe pulling back and hitting recent lows in the low 90s, which would be near 20-day moving average, that's certainly a possibility. And so, and this one's an aggressive stock, hasn't been trading very long, but you can kind of look at it and see the volatility. And just, some folks, this is not the kind of stock that you want to invest in. Others love this kind of stock because it's got the potential to move very fast. It's all in what your individual preference is. All right, 3 you must see. Let's wrap this up. First, I just wanted to point out Kroger, and we'll get an update today, but they reported on Friday. Not a very good reaction there. You can see selling off on very heavy volume, heaviest volume since January. And we finished not on the low, but pretty close. Got to hold this 50-day moving average. We're in an uptrend. So I feel like right here is the key level. I'm going to say $42. Don't want to close below it. Next up is OKTA, which is Okta software company. And it's going down into this gap support zone. So I just wanted to point that out. I'm looking for, I was looking for it to hold right around that 254 level, and it's not. But we could put in a reversing candle. So that's something I'd be looking for today, watching for. But it's not one of the better software stocks right now. It has been downtrending. So maybe it's one you just ignore altogether. I just pointed it out because I thought it was down near key technical area. And then the last one is Dish, DISH, and that one has been going down for 3 days. Big thing I wanted to point out here, not so much where it is right now, but why price support resistance is so important. You can see as we get up above 46, I mean, this is the area 46, 47, where Dish has struggled. This is where selling is kicked in. Volume picked up back in June, right from the 46 level. So we get up to 46 and we sell off again. This, from a trading perspective, is really important because when you get the moves up off of, say, a 20-day test and you get near resistance, the demons that start to go through your head are, okay, I think it's going to go through this time. And so you hold. Instead of taking maybe a 5% profit, you hold. 2 or 3 days later, now you got a losing stock on your hands. And now you're trying to control everything emotionally. And then you're like, well, I'll hold it as long as it holds the 50-day. Well, then maybe if it breaks below the 50-day, you look back, well, maybe as long as it holds these lows. Trust me, I've been there. I've done that, and I still do it from time to time. If it's a stock I really like, I make excuses. I mean, I think it's just in our nature. But you just, the more often you can follow technicals, price support, price resistance, I think the better off you're going to be. You can always buy Dish back if it makes a breakout. Most stocks that break out come back, test support. So you really shouldn't be thinking, oh, well, what if it takes off? Instead, you should be thinking, I just made 5% in about a week and a half. Pretty good money. I'll take it, move on, look for something else. All right, let's see what the market's doing. We've been open for about 8 minutes or so. So we had the really bright green futures still holding on to some pretty good gains. Nasdaq not up nearly as much as what it looked like it was going to be. But the Dow is up over 200 points. S&P 26, Nasdaq 41 on a relative basis. Nasdaq lagging a little bit, and it's been a leader recently. So we'll see whether or not that changes throughout today. Tomorrow, CPI coming out. Just keep in mind, inflation, if it's high, who knows? We're not far from the second half of September. Markets, when you sell off, you normally don't sell off for nothing. Normally there are reasons. There's something that the media will focus on. So we want to kind of keep our eye out. I would be looking for inflation, seeing how the market reacts to that, because who knows, maybe that's what's going to be used for the next couple of weeks. But just be careful as we go into the second half of September. I think it's worthwhile being a little bit careful, and maybe if the market keeps going higher, okay, maybe you give up some of those profits. But I think it's prudent just based on history and what we normally see the second half of the month. All right, that's it for me. Listen, everybody have a great day. I hope you had a great weekend. I'll be back tomorrow over at Stock Charts TV. You can access it right here. You see that link. All you got to do is touch that, click on that at 9 a.m. tomorrow morning. It'll be a recorded version. I'll probably record it tomorrow morning around 7:30, but it gets aired around 9. But just check that out. Tuesdays and Thursdays, you can always get me there, Stock Charts TV. Mondays and Wednesdays, you can get us right here at earningsbeats.com. So everybody have a great Monday. And don't forget Max Payne tomorrow night. Happy trading.